Alright guys, I believe this is going to be one of my more important videos. This is about charting indicators and why should you use them. But first, before we get started, let me say, if you find value in what I'm bringing to this community, hit that like button, subscribe button, and share it with your friends. And also check us out on Twitter at WTrades. Now, as I was saying, this is about charting indicators and why should you use them in the first place? What does it matter? Well, let's start out by looking at a chart. Oh, well, you can see I always use too many lines. No, but this is always kind of a funny joke about it. You know, they start showing off all these lines, and they're like, you see this here and that there, and all this other BS. Guys, it doesn't have to be that difficult. So, let me start off by saying there are 3 different main indicators that I like using. And I use them almost on every trade, whether it's long, short, day trade, it doesn't matter. So this is one of the stocks I've been looking at here recently. It's WOOF, and we are on the 4-hour chart. Most of the time, if you want to see if a chart's going to be good for anything at all, you want to look at the 4-hour chart first. About the only time you wouldn't look at a 4-hour chart, and even then I still peek at it, is on day trading. But as you can see with this 4-hour chart here, there's a bunch of different colored lines. Those are called moving averages. One type that I use is a simple moving average, or just simply called moving average. The other is an exponential moving average, or EMA. The other type of indicator I use here is an RSI. And then the third is what they call a MACD. Now, on a MACD, what it uses 2 moving averages and this center line with these bars, red or green. The RSI, it uses a moving average too, but this is a momentum indicator. I like to think of it as buying or selling pressure. And you can see that there's some numbers over here that we'll go over. Now, a moving average. You've heard me say moving average on every one of these. What is a moving average? It is the average price over a certain time period on a certain chart. If you see, if I move to the 15-minute, now that they've changed. Same thing with the 3-minute. They've still changed. They may not be in the same order, same place, whatever. That's because on different charts, different time charts, it'll move differently. Now, what kind of price movement are we talking about here? These are the type of indicators that I use on moving average and exponential moving average. They go by days. Now the ones I use, let's start out with the moving average. If we take off the exponential here, I've got 2, an 18 and 100. Now here in a minute, I'll tell you that there's really only 3 that you really need. I watch 5 just because that's the way I trade. I like to look at what other people's looking at. But really all you need is 3, and I'll go over that right here in just a minute. But first let me show you what I use. So on the simple or regular moving average, I use an 18-day. So that's the price average over an 8-day period or 18-day period. And I use a 100-day. So that's a simple moving average over a 100-day period. On EMAs, let's get rid of the EMAs, I use a 15-day, a 50-day, and a 200-day. Now I know you're thinking, well, you said I only needed 3. What 3 do I need? If I had to choose only 3, it would be these 3 right here. The exponential moving average, 15, 50, and 200. But I know some people like to use a 20 simple moving average. I don't really like the 20 or 21. I like the 18 better. So if you wanted to add in a simple moving average, which moves slower, then the 18, you could substitute the 15 for the 18-day. it'd be a fine substitution. You'll see here in a minute they move pretty close together. Either one of those would be fine. So you could use the 18 MA, the 50 EMA, and the 200. Now you're going to hear the 50 and 100 used a lot, especially in swing trading, and I'll show you an example of that here in a minute. So the RSI, like I was talking about the moving average, if the RSI gets to 70 or above, it's considered overbought. That means people have bought it so much it's getting all this pressure behind it. Usually you'll hear the term it needs to cool off, or it needs to come back down, or it needs to back off. That is whenever this gets up so high that there's so much buying pressure. If it gets to 30 or below, we call that oversold. There is too much selling pressure in the market, and you'll usually see it dip back up or consolidate to let that come back up and cool off some. Now, the MACD. Let me tell you, the MACD, I can't tell you too much of the inner workings of it. I just know that there's two moving averages, and I know that there's a center line that they use here. Let me blow this up a little bit more here. And that there's a center line here. So the orange line, sometimes you'll see these colors reversed. I know on my mobile app they're reversed. But the orange line is my MACD line. The blue line is my signal line. When the MACD line, the orange line, is over top of the blue line, it is now bullish. So if you get the MACD line over the signal line and it's separated like this right here, and you start getting these green bars above this center line, that's as bullish as it can get. The only thing you're going to start seeing from there is these green bars growing bigger and this getting higher. That is a great signal. What I'll usually look for first is the MACD line to cross over the signal line and then start to separate, whether it's on top or bottom. That's a good sign to begin with. And then from there I start looking for green bars, and then from there I look for it to cross over that center line if it ain't already over top of it. If you get all three of those, it's like I said, it's as bullish as it can get on that MACD line. So why should we use these? Well, they can give us an insight into price movement and help us. Well, guys, I'll get there in a second. You know what? It can give us insight into price movement and help us predict further price movement in the future. There we go. That blows me away. Alright, there we go. There's that one little thing's not showing up on it. There it is. Okay. So now that we got that straightened out, let's go back to the 4 hour and let me show you a good case for these. And guys, I know this is a more expanded view. This is not me teaching you how to use this. This is more showing you what indicators I use and why should you use them. I'm going to come out with a smaller frame videos, smaller time frames, and go into it a little bit more detail in each one. But for right now, I wanted to get this one out there just like we did with the last videos. I made a longer form trend support and trend lines and all that. I made a longer form video of that. I want to make a longer form one of this one first. So this is, again, this is WOOF, and this is a 4 hour, 180 day time frame. Now, when you're looking at this, the only thing you see is price moving up and down across these lines. So, what can the indicators use? Well, let's start off with one, because anytime you can get multiple one of these showing you a certain pattern, that's an extra feather in the cap that helps you confirm what you're seeing. So let's start off with just one, the moving averages. Let's get this out of our way. So one thing you see is the 200. One thing you'll hear anybody say, if the price is over the 200, it is bullish. So what's one thing you see? Every time it comes up over that 200, it spikes up unless you have a fake out breakout over here. And we'll determine a fake out breakout here in a minute. But look at this right here. If we go back, this is a short, this stock's only been out for a little while. So right here it comes up over. And it looks like we should buy it. So let's just say if we're only going by that 200 and we bought in right here, well then quickly we would see we need to sell it. So that's one against it, right? Shouldn't have bought that. If we're just using that, that's one trade we would have missed on. Alright, if we look here, it goes up and we get above it. It moves about $2-3, about $3 before we would take profit and get out. So that's one for it, but that's not, I mean, it's $3. You know, yeah, if you had 50 shares, it wouldn't be too bad. So, again here, if it crossed above it, you would get another $3 or $4. So again, that's not bad. It wouldn't count as a day trade. You'd still get the money. That's not bad. Let's keep going. So that's 3 trades where 1 would have failed and 2 would have won. Here's another one. It crosses over. As we see, it pops up. It never does come completely down below it, so we would still be trading that. And it pops up on this one. We would have a $6 and about $6.50 earnings. So then it comes down, and now we're at where we are now. It's crossing up over it, so we would enter this trade, and we don't know how that's turned out yet. So we just went by those. It would have, what was it? 1, 2, 3, 4. 4 trades with 1 of them bad and 3 of them good. 1 of them especially good. So that's not a bad average, but I believe we can improve on that if we use some of these other indicators. So now this time, let's add in the MACD line with it. So if we come to this first trade, remember I talked about it needed to be separated and over top and trending up and all that good signs. So if we come to right here, right there where it spikes up, we can see that the MACD line is under the signal line. It is trending down and we have red bars. So if we just used these two, that would cancel each other out and we wouldn't make that trade. Alright, if we come here, we can see that the MACD line is over the signal line. They're separated. It is heading up and we have green bars. So we would enter that trade and we would have got about $2.50 for it. So if we come over here to this one, again, they're separated. They're moving upwards and we have green bars. We would have entered this trade and we would have got from it. Again with this one, it was right here. The MACD line is separated. We have shitload of green bars. It is really pumping up and everything looks great. So with this one, we would have got rid of that 1 bad trade and had 2 okay trades and 1 really good one. And if we look here on the end now, we can see that it is separated, it is green, and it's up over the 200. Because right now we would trade that along with the rest. So let's add in the RSI with it. Again, if we come back here, we wouldn't have took this trade anyway, but we can see that the RSI is having lower lows and lower highs, and it's trending down. So that would have been 2 against, 1 for. So we definitely would not have took that trade now. If we come right here to this one, we can see that they're heading up. We can see that's bullish. We would have took this trade and we would have made something, even though it wouldn't have been great. It would have been about $2.50. Again with this one, it is heading up. It looks good. We can see that it's come down. It's come from a low You never want to trade when it's too hot, overextended. You always want to let it cool off a little bit. But according to all this, we would have traded in. Same thing here. It's not overextended yet. It's still at the 70 or below. It's a good trade. We would know that it being this high, it would need to cool off, so we could expect this downturn here and not get scared out of selling there and then watch it come back up. And again, here on the end, it's not overextended. We know to look for for it to come down and cool off a little bit, and everything looks good. So these trades would have been decent trades. I mean, if we're looking at these just from a standpoint of percentages, like I said, the first two's not like the perfect trade, but it does make you money. We're looking at 11% there. We are looking at 14% there. And we are looking at 25% there. I usually say anything 15% more is a great trade. So we would have had 2 okay trades and 1 really good trade. So guys, that's my case for why charting works and why it is good. And I can show you examples of this. Is it going to work with every trade? Probably not. But that's not the point. You're not going to find nothing that's 100%. If it was, we'd have people that already had it all figured out and everything would be great, right? What you want to do is minimize risk and make sure your wins are more than your losses. And we'll go into further about how to plan out a trade and things like that later, when to take profits. But as of right now, these are good indicators on when to buy and when to sell. Guys, if this is not a good case on why to use charting, I don't have one for you then. I mean, I think I've just showed you right here that on these trades, you could have made money. Are we talking about it going to the moon? No, we're not. You're going to find trades like that with this, but not every trade is going to be an AMC or GME. Look for 10% or better on every trade. Alright guys, that's what I've got for you now. We'll come out with other videos later. I hope that gives you something to think about. If you like what I do, hit that like button, subscribe button, and check us out on Twitter, okay? You have a good one.